what we're going to do today is talk about something that connects a lot of the dots that we've been talking about now, next, later about for a long time. So, data management, data quality, and really change management have been the biggest themes, John, that we have on Now Next Later, as you know, watching some of these episodes and now joining us. And one of the keys is, how do you take that data management and data integrity and make it valuable throughout the closing and delivery process, not just loan delivery to the GSEs, but continuing to drive down costs for loan delivery to other investors as well. We've been hearing more and more about non-QM this year. And so for everyone watching, thank you. John Levonick is with Garris Horn. John is one of the experts that I always turn to whenever I have a question when we're talking about loan due diligence. We're talking about loan pool delivery, any type of loan product standardization, especially for the capital markets and the secondary markets. I go to John. And so, John, thank you for joining us. We're happy to have you today.
Super thrilled to be here, Jeremy. Thanks.
Yeah, right on. So now, next, later, what we're going to do is we're going to still do the half an hour. That way we will have the full time with you. We'll post it to YouTube, and everyone who maybe dropped off because we were a little late, we can send them the video and they can see it. But we always start with now. We always start with the where are we now? And one of the things I asked you that I was hoping, to dig into straight away is we joke a lot about how long it takes in this industry to make change or to adopt change. But we've seen dramatic change in data visibility, in data collection and accessibility. We're getting source data now. Both Fannie and Freddie have single source validation projects up and running, and a lot of lenders are using direct source data for day one certainty, for delivery to both the GSEs as well as non-QM and other investors. So can you talk a little bit about the lay of the land? Where are we now with the data quality, data capture, and data delivery specifically for the capital markets and the loan delivery process?
Well, it's still a very manual process, Jeremy. There's been so much discussion, especially through this webinar, about quality of data, especially as you just mentioned. Data is the underlying element to marketability of a loan. The marketability of the loan is the value of the loan to investors, to anyone that wants to acquire or purchase the mortgage loan. Currently, there's zero trust in the manufacturing process. Lenders are starting to avail themselves of, obviously direct source data. But at the end of the day, Jeremy, the manufacturing process needs verification and validation of the data quality for us to move towards a more data-centric marketing and delivery of loans into the secondary market. The current processes are manual. A loan closes, a loan is submitted to a third party for due diligence. 5-10 human beings reverse engineer the manufacturer of the mortgage to make sure it's manufactured. Time, cost, it creates a really, really high friction experience between the originator and the ultimate investor. And with the way the market is right now, we talked a little bit about the GSEs. The GSEs have given us a blueprint on how this can work on a larger scale. So I'm really, really excited to be here today to talk to you about that.
Absolutely. I think that when you say that the GSEs have given us the model, one of the things we've seen work is mimicking the GSEs for non-agency delivery, right? Non-agency investors offering their own AUS. As an example, what are we seeing in terms of data, either validation or revalidation, that non-agency investors are doing that mimics some of what I described in the intro as what the GSEs are doing? Are we there yet?
We're not there yet. Believe it or not, I think the GSEs are going to lead the way and set the standard for the non-agency non-conforming process.
That's so if the if the standard remains, locking in the data, comparing the data once it's delivered to what you said it was. So there's still going to be a system to system comparison, whether that's an Excel spreadsheet because you call it a loan tape, or whether it's just in some other UX feature, whichever it is, we're still doing the did it look like what I thought I was buying, or does it look like what you said you were delivering? And my understanding is technology wise, we're already able to go way beyond that. And so what you're saying is like the process, the trust slash legal implications are the only thing holding us back. Could you talk for a little bit or just a minute about where the technology is? And then we'll talk about the culture and legal issues that we need to change too. Where is the technology today in terms of like data integrity?
I think the best example is in the UCDP, the Uniform
Okay.
Collateral Delivery Portal, right? That's a great example of where this model needs to scale and get to. What the UCDP currently does, it's it's the portal for which collateral data is submitted, and there are hard stops built in. Hard stops meaning that if a data field is empty, or if a rudimentary field that can be verified through business logic is incorrect, it prevents the user from successfully uploading the data set. So imagine that at a larger scale. Instead of just the collateral data, think about having the ability to take a UCD or ULDD and run that ULDD through, whether it be a rules-based engine, some sort of data validation oracle that prior to successful submission has the ability to take that data, verify that data verified against itself based from data within the loan file, and validate the data, which also means that is this data as it's presented sufficient on its face to comply with the guidelines, for example.
Mhm.
So imagine a scenario where the ULDD is pushed into a portal rejects it, right? Credit score
Mhm.
outside acceptable threshold, or verification of employment does not match 1003 representation. The ability to leverage technology today, or the ability of technology today, it's there.
Yeah.
There are these automated verification tools that could run on data tape information. And also imagine a scenario where not only the ULDD or UCD is uploaded, but some sort of, standardized extract out of the LOS, where the tool within seconds can give a high level analysis of that loan's eligibility against guidelines.
Mhm.
The data provenance, has the data been verified against the source, the true source, authoritative source, and are the rudimentary validations correct? DTI,
Mhm.
LTV. That exists today. So the industry, which I have yet to see, really needs to implement this delivery threshold. And it could be really useful for GSE delivery, or it could be really useful to a non-conforming investor, where, conducting due diligence for a non-conforming investor, it's expensive, six, seven, $800 probably in per loan file, and the delays 2 to 3 weeks at times for
Mhm.
diligence outcomes. The ability to automate threshold determinations of loan quality to identify loans that have highly probabilistic defects or deviations from the guidelines. Um, and then you route those loans for maybe a human in the loop. That loan then goes
Mhm.
to a human for re-verification. The technology today can significantly reduce the need for due diligence. Obviously, if it's slated for RMBS, the rating agencies will have to buy into those controls and those thresholds. But the unnecessary, in my opinion, use of due diligence on all assets, on a high proportion of the assets, it's costly and unnecessarily time consuming. So if the right use of the right technology, the friction between the originator and the investor can be reduced. The
Mhm.
time to delivery can be significantly reduced, and sometimes even for those using warehouse lines, a loan could sit on a warehouse line for exorbitant period of time after consummation, costing the originator significant money on a daily basis. Compressing that timeline, increasing the velocity to acquisition. This tool has, these tools that could do this have obvious value. And I hope to see
Yeah,
something in the near future.
When I was at Rocket, we compressed loan delivery through the use of digital closing, and
Mhm.
in a variety of other ways too, with some like data integrity processes getting to closing. But just adopting digital closing cut about 12 days off of our loan delivery and trailing docs and some of those settlement related issues you were just talking about. And it was to the tune, I mean, it was no joke. It was to the tune of $25 million a year savings, just in that kind of 12 days difference on the warehouse line or hedging or all the different things that come in on top of that from a capital markets perspective. So one of the things I don't think we say enough is it's real money when you're talking not just the due diligence cost that is, like you said, per loan file for a third party, but also that time frame you just mentioned.
Yeah, the curtailments are meaningful.
And you said two or three things I think we need to dig into. One though is you said provenance, and I've always wanted to ask you this question. So how do you define that? How do you when you're talking to clients, when you're talking to lenders about data provenance or the concept of provenance, what does that mean to you, and how should lenders be thinking about that concept?
It's a great question. Provenance is the relationship between the data as it resides within a data structure and the data as it resides on the authoritative source, right? It's a very
Mhm.
broad term. Data validate, direct source data. Great explanation. The trust between the data as delivered from the DSD provider, that's authoritative. That is an authoritative source. That data lands into an LOS. That LOS maybe has some sort of flat file architecture where that field can be overwritten. That field can be corrupted in some sort. So the trust between the data as it resides in that data structure under the control of the originator and the data as it was presented by the authoritative source, direct source data provider, that nexus is lost. So establishing that nexus between authoritative source and the data as it resides in whatever location, wherever it might be.
Mhm.
That's
And
data
the
provenance.
other, right, exactly. And so um, the question that's always brought up for me is uh, where the culture that I mentioned earlier and the legal implications kind of mix with technology and data provenance means, I think, greater visibility into how the data is actually collected and what a lot of lenders call it is the manufacturing process. But
Yes.
investors, I think, appreciate or enjoy is maybe the legal way to think about it. They enjoy an arm's length from the manufacturing process. They don't have to see how the sausage is made, to put it bluntly. And with systems that are operating off of authoritative data, operating from the bank account, operating from the source of whatever that financial authority or trust authority that we were just talking about, whether it be a credit score, employment, obviously income and assets is one, I'm referring to with bank statements. You end up with a greater visibility into what changes are made, how they were made, when they were made, by who. It, to me, that's a good thing because that's the only way to push through and get to some of the real time innovation that we've been hoping for when you're funding a refinance, when you're funding second liens or home equity. But it also means you can see some of difficulty in loan manufacturing. So, how are you advising clients? What are you hearing from investors? How are we going to manage that challenge when we know it's still pretty messy how we get to income calculations or how we get to some of the other data that we need to clean up for loan delivery?
Oh, you know me well enough. I always live in the land of similes and quotes. One of my favorite movies, Few Good Men, right?
Yeah,
Um,
mine
the quote
too.
I always say to that is, "It doesn't matter what I believe; it only matters what I can prove." Right?
Hmm.
And
Yep.
and currently, the way the market works is that there are contractual representations and warranties made as to the loan quality. Right? That's the contractual threshold between the investor and the manufacturer. That's an attestation to the quality of the loan. With the capability now of technology and the pairing of data to its source or authoritative source, investors have the ability to not only get what they deem to be trusted data, but what can be verified data. So the ability to verify and create that, locked in nexus between a data value and the data source, as that travels through the manufacturing process, that confidence in the data should be able to pass to the investor. Right now, investors are getting, bid tapes. The bid tape is a mere representation of the characteristics of the loan that the investor is relying upon, if validated, if proven to be accurate and true, is what they're seeking, to buy. Yes, we will buy loans if they meet these thresholds. But the data tape, the bid tape, it's junk. It's useless. There's
Yeah.
zero trust in that. We need to get to a point where the data extract from the LOS or the data extract from an independent trusted source has taken the LOS data, has taken the data as it resides on the key documents for which the consumer viewed, consumer touched, consumer saw, and ultimately creates a data set that has been verified and validated and that the investor can then rely upon. The the bid tape should be just a redacted form of the actual data of the loan as
Hmm.
verified. Sounds simple. It sounds very simple, but that is the biggest chasm that we need to cross right now as an industry. You've got a highly configurable manufactured process where outcomes are not trusted until they're proven to be trusted. So while, I don't see quality control, third-party quality control firms and due diligence firms going out of business, what I see is the ability to automate these verifications and validations in near real time, whether it's in parallel to the manufacturing process, whether it's prior to consummation, whether it's immediately following consummation. These near real time verifications and validations need to produce an authoritative, verified, validated data set. And it's that simple, Jeremy.
So that kind of leads us from kind of one foot into what's next into what's later. And one of the areas that I think you just brought up is I want to be able to connect not just the timeline, but also the representation of that data so that now it's not just, let's call it a picture of the data in a spreadsheet, but it's the actual verification in um, in some way, some system that says this data is certified. This is the data that the originator saw. It is the data the underwriter saw, and it's the data that you get with this loan by buying it, right? That
Yes.
that to me that to me is um let me put it this way. It lacks a universality right now, right? I as an originator, I need to be able to sell to a bunch of different investors. So I need one system, but I need to expose that system to any investor. So as we think ahead to how do I take what I'm doing, manufacturing loans all day, and holding this source data, but then putting it in something that is probably not the LOS, candidly, because they're not producing right now this type of technology that would let whomever you expose it to see that it is actually the data, not a tape, right? And so, where do we go from here? What is that system? How far away are we really from that? Because that to me, and the reason I'm asking this question is, it feels to me like that actually gives the power back to the originator. I think over the last 20 years, we've kind of like removed all the power from the originator. All the power lives at the GSEs. All the power lives even in the at the non-QM originator level, like who's aggregating my loans. And the originator's not actually making a lot of decisions, candidly, especially in the GSE environment. It's like I'm doing sales and marketing, and then everything else is on them, or everything else is on my vendors. What you're saying actually, I think, tips the balance scale back in favor of originators to say, now you're manufacturing this loan, you have this data, who are you going to show it to? I'm going to show it to like the highest bidder. So walk us into later. Walk us into like what would be the ideal universe for originators, and what would they need to realize that?
You nailed it, Jeremy. It's taking the visibility into the veracity of the data and presenting it to the originator in near real time so they can establish trust, right? Meaning a loan is manufactured to predetermined specifications, guidelines. We know that anything can go wrong during a processing and underwriting of a loan, right? So if an
Sure.
originator is targeting a loan against the guidelines or commitment, or an array of guidelines, this power, this capability, not only for delivery of quality data to the secondary market, what this does is it empowers the originator to make better determinations for that lender in near real time. Meaning, as the bingo card of data starts getting filled, an originator should have the power, and if they have available to them an array of investors, the ability to truly best X a loan versus target it towards one investor. It falls out, then you find another investor or find another place to put that loan. Having the ability to verify and validate the data in parallel to manufacturing creates a best execution, right? Which can exponentially increase the margin on the sale of the loan. It allows an originator to better control the remediation of any defects. So if there's a guideline deviation, right, which means it's something that's not bad, but takes it out of eligibility for that particular delivery model. But if there's a defect, if there's a mismatch, there's something wrong with that loan, then the originator, prior to prior to consummation, prior to the issuance, it should ideally happen right at the time of the, drawing of the final CD, get an assurance that if there's a mismatch, if there's a problem with that loan, they can then fix it. They have control of their ability to fix it. And once they fixed it, then again, ensure that the eligibility standards have been met. But at that time, what it does is increases pull through. And it gives confidence to the originator that that loan in near real time is of investment quality. And I think you and I have talked about this over the years, Jeremy. Independent mortgage bankers deliver predominantly to the GSE and agencies because they're comfortable, they're confident, they have an ability to make representations as to the loan quality and then deliver it. They've got 100% pull through. These IMBs are fearful. Many of these IMBs are fearful to deliver to Wall Street because what due diligence is, it's a fine tooth comb. It's no IMB wants their loan, whether it be 1 in 5, 1 in 7, 1 in 10, to be deemed to be not eligible for sale for whatever reason. That terrifies them. So if this tool works appropriately, it could give the assurance to the originator that that loan meets investor guidelines and
Mhm.
it is of investment quality. So when it goes through due diligence, there should not be any deviation or defect or problem found, which gives ultimate confidence in that IMB to push loans into the private capital markets without fear of recourse at the due diligence level.
Yeah, you brought up the key point, which is I want to limit liability in every way possible. That's my job. And as an originator, especially as like the CEO of the originator thinks about it, That's my responsibility. So if we kind of track to how technology has been created and deployed in this industry before, reps and
Mhm.
warrants and the LOS being the source of truth are two really key factors. So we got a question in the chat, John, and the question is this: if we think about it this way, is it actually the technology then, the certification process of that data, that is rep and warranted, so to speak, on behalf of the originator? Do you see it going to where it's going to be a vendor, it's going to be the LOS, it's going to be some certification on top of the LOS that is essentially giving some insurance or rep and warrants to the originator so they can pass it through, versus the originator having to trust, the technology themselves? Is that where we're headed? Do you think there's a role
The
for that?
industry's been using this insurance in a patchwork of ways over the past few years, right? This first loss insurance coverage, right? If the loan was
Okay. Yep.
manufactured according to specifications, you have somebody that can attest to it. And that attestation process is deemed to be trusted enough to where an insurer can issue a first loss policy against that loan having any defects. So
Mm-hmm,
absolutely, this independent,
mm-hmm,
trusted third party, whether it's decentralized, centralized in a trusted authority's hands, um, that technology, when it works appropriately, can absolutely issue insurance that will protect the investor against,
mm-hmm,
to offset, a whole loan repurchase demand, to cover indemnification in the event of loss if that tool did not make a correct assertion as to loan eligibility. So
mm-hmm,
absolutely, what that does is it curtails an originator's trailing liability, which is
mm-hmm.
which is significant, right? Um, and
Yep.
and it and it gives an investor the confidence that a repurchase demand or a request for indemnification is not going to put a counterparty, the originator, on their financial heels and hurt them. Because at the end of the day, Jeremy, investors are in the business of buying loans. And
Right.
investors are in the business of ensuring that those that sell them loans stay in business so that investor has recourse in the future if that loan is ever found to be defective or it fails to meet the representations and warranties. So absolutely, insurance helps all parties.
So we've successfully avoided um, using some phrases of the actual technology, right? We've avoided saying blockchain, we've avoided saying AI. And I'm going to break that rule right now and ask you: I think a lot of people listening would say, well, this sounds like a job for AI. Like, I'm being told that AI can do all of these amazing things when it comes to contextualizing data, when it comes to quickly analyzing data against complex guidelines and frameworks. Like, you've described something that I think a lot of people go, okay, so somebody's going to make that for me. Somebody's going to sort of build that AI for me. Am I right in that assumption? Is this a job for AI? What's your view on who
It,
comes up with this
it's
solution?
it's certainly, a traditional SaaS that has a rules-based engine cannot anticipate the various characteristics of a consumer. I think you've been on the origination side. You know, no two consumers are in the same financial position, whether income, assets, liabilities, REO, whatever it might be that the key elements to the underwrite are. So yeah, AI is certainly, the I've been having conversations with people that say, well, AI is, it's probabilistic versus deterministic, meaning deterministic is binary, good, bad, yes, no. Where AI doesn't come to deterministic outcomes, it comes to probabilistic outcomes. And if AI thresholds could be set to high confidence rates in the probabilistic outcome, meaning, 90% confidence in this outcome, honestly, Jeremy, that is still better than sending that file to a diligence provider who ships it to, an office that might be located in a different country to be reviewed by an individual where English is a second language. And, the confidence in a diligence outcome is significantly lower, in my opinion, in that of a
Mhm.
highly probabilistic AI determination.
Yeah,
So
I
yes,
mean,
yes, AI is the right tool for this, without a doubt.
yeah, I think you've just honestly, I think you've just defined a future where we fundamentally change what risk-based pricing means, right? Like we are focused on risk-based pricing relative to the credit risk of the homeowner in the collateral. But what you're saying is we actually now could do real-time underwriting, real-time verification and delivery, even frankly, and it will be risk-based on what is the probability, what's the likelihood that this contextual data indicates both a credit risk or a manufacturing risk, and the higher the score, you can kind of weight the product, or weight the rate sheet differently. So I think, to
Without
me, that's actually really exciting, and it opens up innovation in ways that we probably can't even imagine, or we'd need another couple hours to dig into. So thank you, John, for being here. I'm going to wrap us right here, but I definitely want to have you back as we see these tools develop, as we see, people going to market with this stuff. You're the expert on this, so thank you for being here. It's great, everyone. Thank you for joining us live and sticking with us on Now Next Later. We're going to record this, send it out via YouTube. John, I'll send you the link. We'll post it as usual to the Chrisman Commentary and all the channels, and make sure that if folks didn't hear it, they can then share it. So thank you so much, John. Really appreciate it. Great conversation.
Thank you, Jeremy.
Talk
Talk
to you
soon.
soon.